Okay, so we'll be able to now look at the chapter 7. So chapter 7, this is where we look at the cost of capital or the capital structure and financial leverage. So to start a new business or to finance a particular business uh, project, a company requires capital funds. These funds come at a cost, and this is known as the cost of capital. Capital comes in various forms, which include the following. So we have the types of capital, where we are looking at the common share capital or common stock or equity, right? Then we also have the preferred stock or preferred shareholders, okay? Then we also have what we call debt capital or loans. Then getting down to the retained earnings, right? So each of these capital carry a cost, okay, and that is the cost of that particular type of capital. The cost of capital is what each provider of the capital demands as compensation for using their funds, okay. To the provider of the funds, this is their required rate of return. So why is cost of capital important for for value maximization of the firm, then also capital budgeting decisions, then of course for other cost decisions, right? Okay, so think of how you can explain. So think of how you can explain each of these 3 points above with examples. So the form of capital that a firm uses in financing its business makes what is known as a capital structure. A company may use only one type of capital, say common stock, or can use a combination of different types. All right. Then there's a cost of debt. Okay. Debt is borrowed capital or loan provided by the lender, that's the creditor, in exchange for interest payment. The interest paid on a debt at a given rate is the cost of debt capital. Okay. Since interest expense is deductible under tax rules, this creates a saving for the company due to what is called the tax shield, which is 1 minus tax. So the tax shield lowers the overall cost of debt, which is a benefit to the company. All right, the cost of debt, KD, before tax. When you take into account the tax shield, this changes. Okay, the tax is 40, then the new cost of debt is 81 minus tax. So the capital structure can consist of common stock shares, the debt, and the preferred stock. So in this case, if you have this question where I say the debt cost is at 10%, so debt cost at 10%, and the tax rate is at 40% for the company tax. So what is after tax cost of debt? So after tax cost of debt will be 10% one minus tax, which is giving us 6%. Okay. So the cost has been reduced from 10% to 6%. All right. So the cost of preferred stock. So preferred shares are a hybrid from equity, semi-debt, semi-equity in nature. The dividend paid is a fixed and is a percentage of the share price, e.g. 10% preference shares, meaning that your dividend is 10% of the price you paid for the share. Okay, so cost of preferred stock is over the dividend over the price. So if you have the preferred stock pays a dividend of 11.7 and sells for 100, find the cost of preferred equity. So our cost of preferred equity, all right, so it will give us the 11.7, then you divide by 100. Okay, so this one is giving us how much? 11.7 divided by 100. Okay, so your cost is 7.7%. So the cost of equity is a capital supplied by ordinary shareholders. These are the owners of the company. Despite them being the owners, they too require a return for the amount they have invested. Otherwise, there is no reason to invest. Shareholders expect to gain from their investment in two ways: through share price increase, capital gains, and dividend paid by the company. The two components form of cost of equity, which can be computed using the following: cost of equity using the capital asset price model, where we have return of the market. So we have using the CAPM, using the CAPM. Okay, so cost of equity is actually equal to risk-free plus beta return of the market minus risk-free. Okay, so this is how we get to the cost of equity calculation. Okay, so where we have here RM minus RF is actually equal to market risk premium. Market risk premium. Right, so market risk premium This is what we have here. Okay. So we move on now to the other component. So KE, this is using the dividend growth model. So dividend model. So the dividend model. So dividend model. So we have the cost of equity is equal to D1 over PO plus G, where right, so where D1 is actually equal to DO 1 plus G. This is where we have this one. Okay. All right. So PO is the stock price. Okay. So PO is equal to the stock price. Okay. And then G is the growth rate. All right. So G is the growth rate. All right. So this is what goes on. Okay. So from here, we have, okay, so we can see where we have this one. Suppose for a stock, the risk-free rate is 8%. So 8% is risk-free. Then return of the market is at 14% and beta is 0.7. Find the cost of this equity. So you're using just KE is actually equal to RF. Okay, then plus beta RM minus RF. All right, I'm sure you are following so far. Are you following? Okay, so our cost of equity will become what? As we subtract our cost of equity to give us what? 14 minus 8, then multiplied by 0.7 plus 8. So it's giving us 12.2. So we are getting 12.2%. All right. So this is what is going on here. Okay. Is that clear? Have you followed so far? Hello, Madam Banga. Are you with me?
Yes, we're following.
Okay, so now let's look at the other component now. So the other component is where we are getting down to a stock expected dividend D1 1.43 and the growth rate is 6.6. The stock sales for 25.54. What's the cost of equity using the Gordon model? So D1 is 1.43, PO is 25.5, and plus the growth rate, which is giving us 12.2. So now we look at what we call WACC. Okay, WACC is the retained earnings is internal equity. So this one is called internal equity. Okay. All right. So we have this one as internal equity, which is the equity raised by applying back the profit. All right. So now let's look at the weighted average cost of capital, the WACC. When a company with a given target capital structure uses the different forms of capital in its capital structure, an average cost of capital will be computed. This is called weighted average cost of capital. The formula is given by this, where we have now W means weight of each form of capital used in the capital structure of the firm. Okay. So weight of equity, cost of equity, weight of preferred stock multiplied by cost of preferred stock. Then we have weight of debt multiplied by cost of debt, 1 minus taxation. Okay, so this is what goes on. Now here we can have this question here. So let's find the WACC from this question. So our WACC, okay, so the capital structure for the company Z extracted from the balance sheet. Okay, so this capital structure we have the debt, the preferred stock, and the common stock. Okay, so the weight you are dividing this is 3 million divided by 10 million. You are getting the 30%. So the weight is 30% here. Then the other one is 1 million divided by 10 million is 10%. 6 million divided by 10 million is 60%. So what you are simply saying now here is that the total weight, okay, the total weight is giving us 100%. So this is the total weight. Okay, so this is the weight of debt is 0.3. Then the other one, the weight of preferred stock, okay. So we have weight of PS is 10.1, and then weight of equity is 0.6. So this is what is happening for the weight. Okay. So suppose a company has a foreign cost for each form of capital, cost of debt, which is a KD, cost of debt is 10%. Then the cost of preferred stock, KPS, is at 12%, the taxation at 40%, cost of equity 12.2, find the WACC. So we're just substituting here, weight of equity times cost of equity. Then this is weight of debt. This is the weight of preferred stock multiplied by the cost of preferred stock, which is 12%. Then the weight of debt, okay, using the formula here, this one, we are going to have the overall average, okay, weighted average cost of capital of 10.32. Okay. So now we book value versus market value for WACC. The book value of WACC is where the weights are based on the par value for the capital components. If especially these were book values. Okay, now another approach is where we can look at the market values to determine the weights instead of the book values. Okay, so the market values, of common stock will also factor in the value of retained earnings, since the market price of share adjusts for all relevant information, which includes profits made by the firm. When market values have been given, use these to find the WACC unless stated otherwise. So determine the market values. So you have this question. The company has 1 million shares outstanding with a par of $2. Market price is at 2.5. The debt is valued at 1.5 million. And the market value of preferred stock at a market price of 1.5. Outstanding shares is 500,000. Okay. So capital structure at market value. Okay, so the debt is 1,500,000. The preferred stock will multiply now by 1.5 to get this amount. Then the equity, instead of a $2, you multiply it by 2.5, which is getting 2,500,000. And then the total capital comes to 4,750,000. Right. So the weights will be debt at 31.6, preferred stock at 15.8, and then the equity at 52.6, finding the weight. So this is dividing 1,500,000 by 4,750,000. Then after that, we plug in the formula. We plug in the formula for WACC, where we are simply saying weight of equity multiplied by cost of equity, then plus weight of preferred stock multiplied by cost of preferred stock. Then, of course, we also now look at the cost of debt, then 1 minus tax, of course, with the weight of debt. So our work will be resolved. Right. Looking at the so we'll be resolved looking at the market values. Okay, so I'm sure you have actually gotten it, unless otherwise. So is that clear? Are we at par now? So these weights, yeah, you are just dividing by this amount, and then we using the appropriate cost values, we can calculate the work as you plug in the equation. Is that okay, Madam Mwanga? Are we together?
Yes.
Do you happen to have a calculator with you?
I'm here. I'm calculating.
All right, so you can calculate for me if we have that capital structure and the weights and the costs are here. So what answer are we getting now? So we try to sort out the issue here so that we see what answers we are going to get. All right, so I've given you 5 minutes to try to find our work. What will be our work here? Using that information. Our work will give us what? Just give me the final answer. Just give that this information. And then using the formula which I've given you there. Weight of equity, cost of equity, plus weight of preferred stock multiplied by cost of preferred stock, cost of debt, 1 minus tax, and weight of debt. All right. Is that clear? So let's also sort out this issue. What answer are we getting? So I've given you 5 minutes to try. Okay, so the value now, we can, we sort out the value. Okay, so it's giving us 0.12804. So our work times 100 giving us 12.804%. Okay, is that what the answer that you found?
Yes, it is.
Yeah, okay, thank you very much. So this is how we are looking at the overall capitalization of the company in terms of debt, equity, and the preferred stock. All right, so we end if we end for now, we end on this one. Okay, so the other